In our latest opening bell report, we do a scenario-based simulation study to find out when markets might be getting too hot. Bitcoin has experienced numerous price cycles throughout its short history, and price predictions often hinge on the expectation of a peak. However, Bitcoin still behaves like a risk asset, and institutional traders might be more interested in basis points or cash and carry strategies than in a true store of value investment. We built a scenario-based study around the most commonly used metric, the relative strength index, and to be a bit more specific, the reverse RSI, which gives an actual price if markets were either oversold or overbought. To make things a little more sensitive, we overlaid a 3-month momentum aspect to ensure that prices don't get triggered against momentum. Just to clarify, the study isn't that Bitcoin will necessarily reach a new peak, but if prices break certain levels within specific timeframes. The market might be suggesting a potential peak, as investors may be more inclined to take profits, especially in a high volatility environment. High volatility often comes with negative returns. There's a small statistical relationship for Bitcoin that shows lower volatility periods make better returns. And as we ran our simulation, we found that lower or similar volatility can allow Bitcoin room to grow to much higher levels, avoiding any triggers that could spook investors because the price moved up too quickly. Thankfully, 2024 was a great sample of data as it included plenty of bullish and bearish catalysts. We look to mirror, but not match possible price paths that the cryptocurrency can take to find what levels might signal that markets are overextended. Our model output, after thousands of simulations, gave an 80 to 90% level of accuracy to last year's trading profile for Bitcoin. It showed, depending on volatility levels, similar or lower than last year, that price triggers would range from $140,000 early in the year all the way to $200,000. The data suggests that the longer Bitcoin goes without breaching these price levels, the higher it can go. Before we get ahead of ourselves, it's important to note that market sentiment matters. While our model is accurate, it was triggered early on some occasions. In 2017, our model was triggered a month before its peak, but at the time, market sentiment was only then a fraction of what it was by the end of the year. And in 2021, our model indicated a $42,000 peak before dropping to below $30,000. Its rebound came only weeks after because Tesla announced it had put Bitcoin on its balance sheet. Even with the most accurate metrics, getting a temperature check on external catalysts, whether positive or negative, is crucial. Importantly, we gave our simulation no directional parameter, only to find various paths for the price of Bitcoin using last year's trading history. For example, the simulation also gave a bearish scenario showing Bitcoin trading to below $57,000 before reverting to a new all-time high in November. This output, which resembled last year's trading profile to 90%, didn't trigger any overbought levels. For the most part, the simulation provided us a statistical profile for the majority of the prices paths between 80 to 90% accuracy to last year's data. What it ultimately showed is that breach levels that could make investors begin to take profits range from $160,000 and $165,000 between May and August. For more information on how we bootstrapped and simulated our data, feel free to read our report.